Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today, the day is September 18th, 2023. Climate Week has just begun over at the UN. We're also going to have some events over here at CFA Society New York. All of them will be talking about how investors can close the gap between the current state and the ones in the SDGs. Today, we're talking with someone who knows an awful lot about that. He is Frédéric Samama, and he co-authored a paper that explains how one portfolio management strategy can do that. Fred is the head of strategic development at S&P Global Sustainable One. Previously, he founded the Sovereign Wealth Fund Research Institute, which is an academic center dedicated to sovereign wealth funds and sustainability. Before that, he worked for Amundi, Crédit Agricole, and JP Morgan in corporate equity derivatives, corporate banking, and other roles. Fred is the co-editor of a book on long-term investing with Nobel laureate Joseph Stiglitz, someone I know everyone at CFA Society New York loves, and has published numerous papers on green finance. He is currently visiting professor at Sciences Po in Paris. He got his PhD in economics at Paris Dauphine University, his master's at Panthéon-Sorbonne University, and he has a certificate from Stanford's executive program. So, Fred, we'd like to start with, now we're going to get into the paper first, but let's start with the why. Why did you and your co-authors feel motivated to write this paper and research this topic?
Good morning, and I'm very pleased to share with you some insights around this paper that follows another paper that Patrick Bolton, Matt Sanderson, and myself, we published in the Financial Analyst Journal back in 2016, Hedging Climate Risk. This paper has been quite popular because it was the first one to showcase that we could integrate climate change-related risks into passive investments. And by doing that, it was a way for the investors to tackle the tragedy of the horizon that Mark Carney coined, as we know.
Yep.
Because by reducing the sensitivity to high emitters, it was generating a free option. We were keeping the same market exposure while reducing the risk. And so the product was helping buy time for free. And so that's the reason why it became so popular. We thought a couple of years later that it was important to write the version 2.0, if I could say, of this paper. Why? Because we are observing a fascinating moment. The fact that suddenly, abruptly, governments have decided to be carbon neutral. These commitments were representing only 10% of the emissions back in 2018. Not so much. And in 2021, it had jumped towards 70%, from 10% to 70%. And it means, if we simplify the problem, that the governments are saying we will reduce by, let's say, 80, 90% the emissions. And some governments are already legally binding, like Canada,
Right.
California, Europe, UK, Japan, South Korea, New Zealand. At the same time, the world is not there at all. At best, it's a 2.4 degree world. Right. So there's a major gap between reality and what governments are saying that they want to achieve. And we thought that this gap is actually, for the investors, a regulatory gap. There's a probability that governments will penalize the corporates that are high emitters and subsidize the corporates that are already on the right trajectory. And then we thought, how can we hedge this regulatory risk? By already aligning portfolios with where the governments want to land. And if we can achieve that with a low tracking error, low portfolio impacts, it looks like a good bet. So it's really about hedging a macro risk related to government's commitment to be carbon neutral that will certainly lead to more regulations on high emitters.
Yeah, okay, so this is really exciting right now because the gap has become obvious to a lot of people. And it's huge, right? It's yawning. One of the things that I enjoyed about reading your paper is it allowed me to view the environmental problem as it is, in the thing that I know best. I'm not a petroleum engineer. I don't really know much about shipping. I don't really know much about nuclear. I mean, I know it conceptually, but I don't really know that much about it. So I would encourage anybody, you can get this paper, the 2.0 paper, and the previous paper you can find on CFA Institute's website. You may have to log in, but you can find it there. So let's talk about what everyone here knows about too, what it is you do. How do you do that?
We went back to science. We said, okay, governments want to be carbon neutral. Who knows what it means?
Right.
Back to school or reality. The ones who know what it means to be carbon neutral is the IPCC. They got a Nobel Prize for that. All the governments are counting on them and so on. And in their last report, they said something very simple. They said, we, the planet, if we want to be carbon neutral, we only have a 300 gigaton CO2 carbon budget.
Right.
So really to constrain the rise of the temperatures to 1.5 degrees means that we cannot plug into the atmosphere more than 300 gigaton of CO2,
right,
starting in 2020.
Right.
Interestingly, in 2022, it means to reduce the volume of CO2 being emitted per year by 12%.
Right.
And then we thought, okay, if it's true for the planet, it should be true for all the proxies of the planet, the economies.
Mm-hmm.
And what are the proxies of the economies? The indices.
Right. Right. So,
yeah, exactly.
Right.
So we said, okay, let's take this minus 12
mm-hmm.
and let's plug it into portfolios. In order for the portfolios to mirror the trajectory of what must be achieved as being explained by the IPCC, that is the reference for the governments. And two things came super interesting. The first one is that we discovered that we could achieve that without disturbing too much the portfolios.
Okay.
It means that we can have a sector neutrality.
Mm-hmm.
You say that I'm not a nuclear specialist. You know what? I'm not as well. I'm not a specialist of oil companies and so on. And what I know is that most of the investors are not as well. So they want to keep the oil exposure, the utility exposure, and so on and so on. And we discovered that we could have this minus 12% trajectory while having the same sector allocation and a low tracking error.
Mm-hmm.
So it was really something fascinating because we can achieve that with limited portfolio impacts. And there was a second discovery. The second discovery is related to the fact that when you have this carbon budget approach, the one that IPCC says, then you say, fine. But how much are we emitting per year? About 35 gigaton. So it means that every year we are spending a big chunk of the carbon budget, 35 out of 300.
Mm-hmm.
So the carbon budget shrinks with time.
Mm-hmm.
And then we said, wow, if we follow this scientific-based approach, for all the investors that will wait, the minus 12% will increase.
Okay.
Yes.
Right.
The minus 12% becomes minus 20% in 2025.
Right.
And minus 47% per year in 2028.
Right. So this is the thing it's fascinating. It's a negative compounding impact, essentially.
Yes.
Yeah.
In a certain sense, Mark Haney was right. Mm-hmm. There is a tragedy of the horizon. But not because it's too far away, but because it's very close to us.
Right.
And here, the paper makes a big splash in the industry. Mm-hmm. Because IPCC had said for years, we can tackle climate change, but the window is closing.
Mm-hmm.
The UNFCCC released a report prior to the Climate Week 10 days ago,
Mm-hmm.
and they said the window is closing.
Right.
And so although there was a clear and loud message for years from the policymakers, none of the financial products ever had integrated the cost of time.
Right.
This paper is the first one to make the case.
Yeah.
And then, although we published a paper in March 2022, very quickly, it got the attention of a lot of people. Someone from the European Central Bank posted on LinkedIn, you should read the paper.
Okay.
Exactly. Personally, I've never seen someone from a central bank saying
Right.
to the industry, go to the website of CFA and get the paper. And their climate specialist, Paul Hebert, was kind enough to start his own presentation by saying, you know what, a new paper has been released, and they framed the debate. Timing is everything.
Mm-hmm.
And they refer to this cost of time.
Yeah.
The GFANS has dedicated an anti-page in that report. The WWF has released an anti-report dedicated to NBIM, making the case that NBIM should use this approach. So although the paper has been released slightly more than 1 year ago, it has immediately obtained a lot of attention from policymakers.
Okay. So when you're, I want to get underneath the hood, so to speak, of the paper in a second to some of the metrics, which I think everyone here will enjoy hearing about. But one of the things that we've run into trouble here with is talking to exceptionally long-term investors about one of the risks that come up for them. And that is if you're an endowment or a family office and you have 150 year time horizon, how do you predict the known unknowns about the regulation?
Because the regulations are already happening.
Okay.
I will give you a concrete example.
Okay.
You heard my French accent, so I will be back to Europe. In Europe, let's take the case study of car makers.
Mm-hmm.
Car makers are a good example because we are all understanding what it means and so on. In Europe, the thermal cars, the production of thermal cars was still representing 65% of the total production in 2022.
Okay.
At S&P, we estimate that it will be 6% in 2030.
Okay.
From 65%
Mm-hmm.
to 6%.
Yeah.
It's very unusual to have such a total change of a large market.
Right.
Why? Because we passed one of these laws that says carbon neutral that we started with.
Mm-hmm.
So Europe is committed to be carbon neutral by 2050. And then the policymakers said, how many years does it take to take cars out of the roads?
Mm-hmm.
15. And so in June last year, they passed another law that say that there will be no sale of thermal cars in 2035.
Right.
And if no sale, also representing 65 of the production now.
Right.
And so if no sale of thermal cars in 2035, 6% in 2030.
Mm-hmm.
Is that already that and other factors shuffling the anti-car market industry? Yes. We estimate that that BYD or Tesla has been produced the Model Y that was the most selling car in Q1 2023.
Mm-hmm.
BYD and Tesla will enjoy between 2019 and 2026 a 800-ish volume growth.
Right.
In 3 years from now, they will produce as many cars as General Motors, Ford, or Honda.
Right.
And one of the key factors was coming from regulations that impacted the car makers at the Scope 3 level. Mm-hmm. They said, you, the car makers, you cannot produce high-emitting cars anymore. So is that already, it's not, here we are not talking about 100 or 100 years, unknown unknowns, and so on. We are talking about something, regulations, either like this or incentives like in the US, or a strategy for China that is already impacting investors' portfolios.
It is fascinating to see how quickly a lot of that change has been made. I think that one of the things that long-term investors wonder about are the unintended consequences of that on their portfolios. Those are hard to think, but perhaps we could have you back for a different podcast after you write that paper. Um, within this paper, I would like to zero in on one thing that I think a lot of people will focus on if they download and read it. Once again, you can get it from CFA Institute's website, and the title of it is Net Zero Carbon Portfolio Alignment. Do go ahead there. We'll put a link to it in the show notes. Was the ex ante tracking error that you all did this, and I thought this was exceptional, a really interesting part. So could you please talk about that?
Yes, we at a point we said, does it fly without impacting too much portfolio constructions? The answer is yes. First, to be sure that we were addressing investors' concerns, and as you say, they're always nervous about unintended consequences and so on. We plugged in the simulations, in concrete lives, sector deviations constraints. It's very easy to get a low carbon product. You just get rid of oil and gas. Period.
Right.
Problem is that this sector has done pretty well. And so if you follow this avenue, well, you can have some underperformances. And so we wanted to have a product that will make the case that no, we can decarbonize the portfolios in a way to be aligned with IPCC without focusing only on oil and gas. So we have a sector neutrality, meaning that we have a very limited sector deviation. And as a consequence, we have a very low tracking error. And so in this paper and with concrete products that have been launched based on this concept paper, we observe that we can achieve tracking errors at inception that are around 25, 30 basis points. Most of the investors can accept that.
Right.
And that keeps under control over the life of the product, stays around 100 by 2035, and so on and so on. So really for investors, they can be carbon neutral as established by IPCC, meaning with a very strong methodology because being scientific based with a low sector deviation leading to a low tracking error.
Right. Now, this is one of the things that, of course, a lot of people on this podcast who are listening to this podcast have to do is they basically have to sell it to a client. And that's the key takeaway, right, for the client, is you don't have to change your investment policy. You don't have to change your asset allocation very much at all. And you get to stay right within the bounds of your forecast.
Correct. And you're hedging a risk. So it's based on a risk management approach, a risk that is more and more on the table. And the methodology is the most, I would say, obvious one. Because the minus 12% that we talked about is coming from the IPCC, so scientific-based approach. And then what the methodology says is that year after year, the methodology will look at the carbon footprint of the portfolio. And either the corporates will have done the efforts leading to the minus 12, then there's no need to reshuffle the portfolios. Or, more likely, the corporates will not have done the jobs, and then there will be a reshuffle of the portfolios in order to achieve the minus 12.
Right.
So it's really very transparent and very robust. On the one hand, IPCC approach. On the other hand, carbon footprint observations, and then with a very simple methodology, reshuffling or not. All that based on scope 1, scope 2, and scope 3.
I mean, it's fascinating. First of all, I can't say enough. Please do go out and read this paper if you haven't read it. If you need to get boned up on something before all the things happen this week and next week with Climate Week, please do that. But Fred, thank you for being here and sharing this with the members.
It was my pleasure. And just to conclude in Why in the World, is that why are this paper and the other papers, because we don't own the truth, so important? Because Mark Carney achieved a fantastic commitment at the previous COP with all the investors being representing $130 trillion being committed to be carbon neutral.
Right.
Truth is that many of these commitments have been taken before knowing how to do it.
Yes.
And Mark Carney knew it.
Yeah.
He thought, okay, I will get the commitments from the
They'll
CEO,
figure it out.
and then they will figure out.
Yeah.
Yeah, true. Truth is that some investors don't figure out.
Right.
And they're exiting
Right.
their
Right.
commitments. And so with Patrick Bolton, Marcin Kakpersik, my two co-authors from Imperial College, we felt a kind of responsibility to bring to market a paper that we hope makes sense to all these investors in order to keep their words. And why that's so important? Because if they don't, civil society could say, you, the financial sector, you made very big commitments, but you're not delivering.
Right.
And that's the last thing we want. We want to keep the momentum because we need it, because we only have 6 years of carbon budget in front of us. So
Right.
we cannot fail. Failure is not an option.
Right. Just a quick note, CFA Society in New York won't say that, but people who are going to speak at our conference, for instance, tomorrow, like Brad Lander, the comptroller of New York City, he might. Just a quick look at a couple of podcasts coming up. We're going to keep this ESG topic rolling. So in the next 2 weeks, with these podcasts will drop on October 2nd and October 9th. We will have a former relatively high-ranking politician from Poland who's going to talk about how you deal with exogenous variables. And on the 9th, we're going to have the founder, person who took an entrepreneurial risk to found an ESG fund, Sloan Ortel. And that one will also feature, for the first time in CFA Society New York's podcast history, video. You all will be able to see me. So until then, podcast listeners, I'm Rob Rowan, and this has been Compound Insights.